Behind closed doors, a directive was issued, one that forced the world's most powerful bank to take the losing side of a trade. Right as silver pushed toward a price the system could not afford to let break. This wasn't about profit. This was about containment, because when a metal gets reclassified as critical, when governments whisper the word strategic, it stops being a commodity and becomes a weapon they cannot let slip from their control. What you're about to hear connects dots most refuse to see. And if you understand what happened in that room, you'll understand why the next move in silver could expose the entire game. Welcome to Currency Analyzer. Now, if you've made it this far, you're likely someone who's lived long enough to know that the most dangerous truths are the ones wrapped in silence. I'm not here to entertain you, I'm here to prepare you. So let me ask you something, with all due respect to your experience and wisdom. If this kind of strategic economic warning, the kind they don't broadcast on mainstream channels, matters to you, would you take just 2 seconds and hit that subscribe button? Because I'm building this for serious people, business professionals, entrepreneurs, investors, over 50, who've seen enough market cycles to know when something smells wrong. And one more thing, drop a comment below and tell me, where in the world are you watching this from? Are you in North America, Europe, Asia, the Middle East? I want to know who's paying attention, because the people who understand what's coming are scattered across the globe, watching the same signals. Now, let's get into what really happened. What happened behind closed doors was not a suggestion. It was a directive, and the target was one of the largest financial institutions on the planet, JP Morgan. The message was simple, but the implications were anything but. Take the short side of silver, absorb the exposure, hold the line. Because silver was approaching a threshold the system could not afford to see broken. Not publicly, not with the world watching. Now, before we go further into what this means, let's establish something critical. Silver has been reclassified, not quietly, but strategically. It now carries the designation critical mineral. And if anyone thinks that's just bureaucratic language, they're missing the entire point. When governments start using words like critical and strategic, they're not talking about coins. They're not talking about jewelry. They're not talking about investor sentiment. They're talking about national security, defense systems, industrial capacity, supply chain dominance, and the ability to wage economic war if necessary. Critical mineral status is not a label. It is a permission slip, a justification for intervention, a framework that allows governments to restrict exports, redirect supply chains, prioritize domestic buyers, and yes, influence market structure when the stakes are high enough. So when silver received this designation, the rules changed, not on brokerage screens, not in the headlines, but in the back rooms, in procurement offices, in refining contracts, and in who gets priority access when physical supply tightens. This is not speculation. This is documented policy shift, and it transforms the entire conversation around silver because a commodity can be traded freely, but a strategic resource. So a strategic resource gets managed. Now let's connect this to the emergency order. Why would a government need to compel a major bank to short silver? The answer lies in understanding what a repricing event actually means. A true repricing is not just a chart moving upward, it is a public acknowledgement that the previous price was artificial. It exposes who is holding the wrong side of the trade. It breaks the narrative that everything is under control, and most dangerously, it forces accountability. When silver was climbing toward triple digits, toward that psychological barrier near $100 per ounce, someone somewhere recognized a problem. If that level broke cleanly, with momentum, the public would pay attention. Retail investors would flood in, institutional momentum funds would follow, and more critically, industrial buyers would panic. Because industrial buyers do not care about technical analysis, they care about securing supply, and if they believe price is about to run away from them, they accelerate purchases, which tightens physical availability even further, which creates the exact feedback loop that paper markets cannot survive. So the question becomes, who was desperate enough to prevent this? And the answer is, anyone with concentrated short exposure in a market too small to absorb a real squeeze. Because here is what most people do not understand about silver. The tradable above ground supply is shockingly small compared to the paper claims written against it. Gold sits in vaults, it gets hoarded, it accumulates. Silver gets consumed, it goes into electronics, solar panels, medical devices, defense systems. A significant portion of silver demand does not return to the market in recoverable form, which means supply constraints are not temporary. They are structural, and structural constraints do not resolve with a pullback. They resolve with repricing. Now, let's talk about what makes this emergency order claim more than just conspiracy theory, because the burden of proof matters, and the proof is not in a leaked document. The proof is in the pattern of behavior. First, there is historical precedent. There have been multiple documented cases where regulators acknowledged that concentrated positions existed in silver. There have been fines levied against institutions for manipulative trading practices. There have been admissions, settlements, and policy adjustments. So the idea that authorities can pressure institutions into taking positions for market stability is not fiction. It is established precedent. Second, there is the observable market behavior. Every time silver approaches major psychological levels, particularly round numbers that attract public attention, something happens. Sudden sharp sell-offs, often in thin trading hours, often with no corresponding news, often with selling volume that appears designed to trigger stop losses and shake out weaker hands. This is not natural price discovery. This is engineered volatility. And engineered volatility serves a purpose. It creates fear. It discourages participation. It makes the asset look unstable, which keeps the broader public away. Third, there's the policy language shift. When silver moved from being just another traded metal to being classified alongside lithium, cobalt, rare earths, and other critical minerals, that was a signal that government priorities had shifted, that silver was now viewed through a national security lens. And when something becomes a national security issue, markets stop being purely markets. They become tools of policy. Now, here's the part that should concern anyone paying attention. If silver is truly strategic, if it is truly critical to defense, technology, and infrastructure, then the current price cannot reflect true value. Because if it did, governments would not need to intervene. They would not need to reclassify. They would not need to tighten export controls. They would simply let the market function. But they are not letting the market function. They are shaping it, which means the price anyone sees is not the price the metal would command in a free market. It is the price the system needs them to see, to maintain stability, to prevent panic, to delay the inevitable. And that inevitable moment is when physical demand overwhelms paper supply. The emergency directive did not happen in a vacuum. It happened at the exact moment when multiple nations on different continents with different political systems all began doing the same thing, tightening their grip on silver, not through public announcements, not through dramatic policy speeches, but through quiet, deliberate actions that only become visible when someone steps back and sees the pattern. China restricted silver exports. Not all of them, just enough to signal intent. Russia moved to secure refining capacity, locking down the infrastructure that transforms raw ore into usable metal. India adjusted import duties in ways that favored domestic retention, making it more expensive to ship silver out than to keep it in. Mexico, one of the world's largest silver producers, began discussions about resource nationalism. And the United States, through that critical mineral designation, gave itself the legal framework to do whatever becomes necessary. This is not coincidence. This is coordination, not the kind anyone sees in treaty documents, but the kind that emerges when major powers recognize the same reality at the same time. That the next phase of global competition will not be fought with tanks and missiles alone. It will be fought with supply chains, with access to critical materials, with the ability to produce advanced technology without depending on adversaries. And silver sits at the center of that competition, because nations cannot build modern defense systems without it. They cannot manufacture high-efficiency solar panels without it. They cannot produce advanced electronics without it. So when nations start protecting domestic supply, when they start limiting what leaves their borders, that is not protectionism. That is preparation. Preparation for a world where the metal matters more than the currency used to buy it. Now let's talk about what's happening inside the market itself. Because while governments are positioning at the macro level, there's a quiet battle happening at the micro level. A battle over physical delivery. And this is where the story gets truly interesting. Because in normal commodity markets, most participants never take delivery. The system is designed that way. Futures contracts exist so producers can hedge, so speculators can trade, so liquidity can flow. And at the end of the contract cycle, most players simply roll to the next month or cash settle. They never demand the actual metal, which is exactly how the paper market stays stable. As long as most claims never convert to physical demand, the system works. But something has changed. Delivery requests have been rising, not in the traditional delivery months like March, May, July, September, and December, but in the off months, the months when delivery demand should be minimal. And it is not just rising randomly. It is rising specifically when price approaches certain levels. When silver climbs toward resistance zones that matter psychologically, suddenly someone wants metal. Not promises, not paper exposure, not cash settlement. They want the actual ounces, and they want them now. This is a signal that participants no longer trust the paper price to reflect reality, a signal that someone somewhere knows that physical availability is tighter than the market suggests. And when delivery demands repeat outside normal patterns, that is the market whispering something most people are not listening for. I do not want your promise. I want your metal. Now, let's address the elephant in the room, concentrated short positions, because this is where rational market behavior breaks down completely. In a normal market, producers might hedge their output, banks might facilitate trades, speculators might take positions based on supply and demand forecasts. But what has been documented in silver for years is something different. A small number of institutions, sometimes just one or two, holding massively concentrated short positions. Positions so large they represent a disproportionate share of global production. Positions so large that if price moves against them violently, the losses could be catastrophic. Now, here's the question that breaks the entire narrative. Why? Why would any rational institution volunteer to hold that exposure? Silver is a tiny market compared to currencies, equities, bonds. The notional value of all the silver ever mined in human history is less than the market cap of a single large tech company. So why would a major bank, with access to sophisticated risk models, with traders who understand position sizing, why would they willingly concentrate massive short exposure in a small market with explosive upside risk? The standard answer is hedging. But hedging does not require concentration. Hedging does not require holding positions so large that they distort the entire market structure. Hedging does not require repeated episodes of aggressive selling into thin liquidity at psychologically important price levels. And hedging certainly does not explain why institutions have been fined multiple times for manipulative practices in this exact market. So if it is not hedging, what is it? One explanation, the one that makes the emergency order story credible, is that these positions are not voluntary, or at least not entirely voluntary. That there is a broader arrangement, formal or informal, where certain institutions act as stabilizers, where they absorb risk that the system cannot afford to let spread, where they hold the line because someone needs the line held. And in exchange, they receive certain assurances, liquidity support if needed, regulatory leniency if problems arise, or simply the understanding that they are too important to fail. This is not conspiracy theory. This is how systemic risk management works in practice. Central banks do not announce crisis interventions before they happen. They act and explain later. Governments do not telegraph market stabilization efforts. They deploy them quietly through trusted intermediaries. And major banks do not broadcast when they are carrying positions for reasons beyond profit. They simply carry them until the moment when carrying them becomes impossible. Now, let's connect this to the physical market stress discussed earlier, because the nightmare scenario for a concentrated short position is not just rising price. It is rising price combined with disappearing physical supply. Because as long as paper claims can be settled in cash, shorts can manage risk. They can cover, they can roll, they can wait for price to come back down. But if physical demand accelerates, if delivery requests spike, if metal starts disappearing from the places the paper market assumes it can access, then the short position becomes a trap. Because now the short is not just betting on price direction. They are betting that physical metal will be available when needed. And if that bet is wrong, if someone stands for a delivery and the metal is not there, that is not a margin call. That is a credibility event. An event that exposes the gap between paper claims and physical reality. An event that triggers questions across every leveraged commodity market. An event that makes participants wonder if silver delivery can fail, what else might fail? And that kind of contagion risk is exactly what emergency directives are designed to prevent. There is a moment in every managed system when the illusion becomes unsustainable, when the gap between what is claimed and what actually exists becomes too wide to hide. And in silver, that moment is approaching, because the architecture of the modern silver market was built on a single assumption, that physical demand would remain predictable, that most participants would trade paper and never ask for metal, that the system could maintain the appearance of abundance while running on remarkably thin physical inventory. But that assumption is cracking, not loudly, not all at once, but in ways that anyone watching the right signals can see. Let's start with the fundamental mechanics, because most people do not understand how little physical metal actually backs the paper claims traded every day. When someone buys a silver futures contract, they are not buying metal. They are buying a promise that if they choose to stand for delivery, metal will be available. But here's what the fine print does not emphasize. That promise has an escape clause, cash settlement. Language buried in contract specifications that allows the seller to deliver cash equivalent instead of actual ounces. Under normal conditions, this rarely matters, because most traders are not trying to accumulate physical. They are trying to profit from price movement. So they close positions before expiration, they roll to the next month, they take profits or losses in dollars, and the system continues functioning. But what happens when normal conditions end? What happens when a critical mass of participants decides simultaneously that they do not trust paper claims anymore, that they want metal, not promises? That is when cash settlement language transforms from technicality into systemic vulnerability. Because if enough participants demand physical delivery at the same time, the system has to prove it can perform. And if it cannot, if the metal is not where the market assumes it is, if inventories have been double counted or triple counted or leased out multiple times, then the market does not get a price adjustment. It gets a credibility collapse. Now let's talk about the signals that suggest the system is moving toward that moment. The first signal is backwardation, and if someone is not familiar with this term, they should pay close attention because it matters more than almost anything else. In normal commodity markets, futures prices are higher than spot prices. This is called contango, and it makes sense because storing metal costs money, insuring it costs money, financing it costs money. So the further out the delivery date, the higher the price should be to compensate for those costs. But occasionally, the structure flips. The spot price becomes higher than the futures price. This is backwardation, and it sends a very specific message. People want the metal now, more than they want it later. They are willing to pay a premium for immediate possession, which means they do not trust that metal will be available in the future at reasonable prices, or they believe that holding physical now is worth more than any paper claim later. Backwardation does not happen because traders are bored. It happens because stress is entering the system, because confidence in future delivery is eroding, because the people who understand physical markets are positioning defensively. And when backwardation appears repeatedly in silver, especially around significant price levels, that is not noise, that is a pressure gauge redlining. The second signal is lease rates. And this is where the story gets even more revealing, because lease rates tell anyone what it costs to borrow metal. In a stable market with abundant supply, lease rates stay low because if someone needs to borrow silver temporarily, there's plenty available. So the cost is minimal, but when lease rates spike, when the cost of borrowing metal suddenly jumps, that tells one of three things. Either metal has become scarce, or the people who own metal do not want to lend it because they smell risk, or someone desperately needs to borrow metal right now and is willing to pay up. None of those scenarios are positive for the paper market. All of them suggest the physical foundation is thinner than the paper structure assumes. And here is what makes this particularly dangerous for concentrated short positions. If someone is short silver and needs to deliver physical, they have two options. They either own the metal already, or they have to borrow it. And if borrowing costs are spiking, while backwardation is appearing, while delivery requests are rising, they are trapped. Because suppressing price does not help if they cannot access metal. In fact, suppressing price makes the situation worse, because every time price gets pushed down, it becomes cheaper for physical buyers to absorb supply, which tightens availability even further, which raises lease rates even more, which increases the cost of maintaining the short position. This is the bind. And it is a bind that cannot be resolved with more paper. It can only be resolved with actual ounces. Now, let's connect this to industrial demand. Because industrial demand is the force that does not care about chart patterns. Defense contractors do not stop ordering silver because the RSI hits 70. Solar panel manufacturers do not pause production because someone on television says silver is overbought. Electronics companies do not substitute away from silver just because a technical analyst drew a resistance line. They need the metal, period. And if that metal is not available at current prices, they pay more. They have no choice because their production lines cannot stop. Their contracts cannot be broken. Their supply chains cannot afford disruption. So industrial demand creates a floor under physical prices that paper markets cannot breach indefinitely. And the more industrial demand grows, the more that floor rises, which means every price suppression attempt has a shorter lifespan because physical buyers keep absorbing the dips. Now, here is where it gets critical. Silver's role in modern technology is not optional. It is the most conductive metal on Earth. It has unique antibacterial properties. It is essential in photovoltaic cells, in advanced electronics, in medical devices, in defense systems. Guidance systems for precision weapons require silver. Communication systems and military hardware require silver. High-performance computing requires silver. And as technology advances, as electronics become more sophisticated, as defense systems become more complex, the amount of silver required per unit increases. This is not speculative demand. This is structural demand. Demand that does not disappear during recessions. Demand that does not pause during geopolitical uncertainty. Demand that accelerates during conflict, because that is when defense production ramps up. So when rising structural demand combines with supply constraints, with paper market stress signals, The setup does not resolve with a normal correction. It resolves with repricing. Or if the system resists repricing long enough, it resolves with failure. Now, let's talk about regional premium divergence, because this is one of the clearest signs that the global silver market is fragmenting. In a truly unified market with free flow of metal, prices should be relatively consistent across regions. Adjusted for transportation and local premiums, yes, but not dramatically different. Yet what observers are seeing now is persistent premium divergence. Certain regions consistently pay more for physical silver than others, sometimes significantly more. This reveals that metal is not flowing freely, that barriers exist, whether logistical, political, or structural, and that the regions paying higher premiums value silver more urgently than the paper price suggests. When Asia pays a sustained premium over Western prices, that is a message. It says, this metal is valued more here, and capital will prove it. And when capital votes with that kind of consistency, it creates a vacuum that pulls metal away from lower premium regions toward higher premium regions. And that flow is one way, because once metal lands in strong hands that value it strategically, it does not come back to the market easily. It gets locked away, vaulted, held, which removes it from the pool of tradable supply, which tightens the physical market further, which makes the next delivery request harder to fulfill. This is how paper markets lose control, not through dramatic announcements, but through quiet, persistent drainage of physical inventory, until one day, someone stands for delivery, and the metal is not there. Every managed system has a breaking point, a moment when the cost of maintaining control exceeds the capacity to sustain it. And when that moment arrives, the failure is not gradual, it is sudden, violent, and irreversible. In silver, observers are watching the approach of that moment. Not because of speculation, not because of conspiracy, but because the fundamental mathematics of the market are becoming impossible to reconcile. Let's examine what makes the emergency order claim not just plausible, but structurally logical. Because if someone understands how systemic risk is managed in practice, the story becomes obvious. Imagine being a policymaker receiving a briefing. The briefing reveals that a major financial institution is catastrophically overexposed to silver, that if price breaks a certain level, margin calls will cascade, losses will explode into the billions. And worse than the financial damage is the reputational damage. Because once the public realizes a market was being actively restrained, once they understand that price discovery was prevented, not facilitated, the response is not just a price adjustment, it is an investigation, congressional hearings, regulatory scrutiny, media attention, and most dangerous of all, a stampede into physical. Because nothing triggers demand quite like the revelation that supply was being rationed. So what does a rational system do in that scenario? It does not allow the break to happen cleanly, it delays, it absorbs, it repositions. And if that means leaning on the largest balance sheets in the room to do what smaller players cannot, then that is exactly what happens. Not through formal written orders that can be subpoenaed later, but through quiet conversations, through understood arrangements, through the kind of coordination that leaves no paper trail. Because systemic stability does not announce itself. It simply acts. This is not theory. This is documented behavior from every major financial crisis in modern history. Central banks do not wait for permission during liquidity crises. They inject capital, they buy assets, they backstop institutions. Governments do not telegraph market interventions. They execute them and craft the narrative afterward. So the idea that authorities would pressure a major bank to absorb silver exposure during a critical moment is not radical. It is consistent with every playbook ever written on crisis management. Now, let's talk about what happens if that strategy fails. Because containment only works if the underlying pressure can be relieved. And in silver, the pressure is not relieving. It is building. There are 5 potential catalysts that could force a failure event. The first is an industrial shock, a sudden spike in demand that the market was not positioned for. Perhaps a major technological breakthrough that requires silver in quantities previously unanticipated. Perhaps a geopolitical conflict that causes defense production to surge. Perhaps a green energy mandate that accelerates solar panel manufacturing beyond supply capacity. Industrial shocks do not ask the market for permission. They simply consume. And if consumption suddenly exceeds available supply, the price does not drift higher. It gaps. The second catalyst is a geopolitical supply disruption. A scenario where a major silver-producing nation faces internal instability, or decides to weaponize its resources, or gets hit with sanctions that restrict its ability to export. Mexico produces nearly 25% of global silver supply. Peru produces another 15%. China controls significant refining capacity. If any one of these nodes experiences disruption, the global supply chain does not adjust smoothly, it fractures. and fractures create shortages, and shortages create panic. The third catalyst is a policy shift. Silver has already been reclassified as a critical mineral, but classification is just the beginning. What comes next is action based on that classification. Export restrictions, domestic purchasing mandates, subsidized stockpiling programs, priority allocation to defense contractors. Any one of these policies removes metal from the global tradable pool. And when physical supply is removed while paper claims remain constant, the gap widens until it becomes unbridgeable. The fourth catalyst is a financial squeeze. This is the scenario the emergency order was designed to prevent. But prevention only works if the short position can be managed. And management requires either price staying below critical levels or physical metal being available to deliver. If neither condition holds, if price pushes higher despite suppression attempts, and physical availability continues tightening, then the short position becomes unmanageable. Margin requirements increase, losses accelerate. And at some point, the institution has to make a decision: cover at a massive loss or default on delivery obligations. Neither option is acceptable, which is why the system would do everything possible to avoid reaching that decision point. But doing everything possible does not mean success is guaranteed. And the fifth catalyst, perhaps the most insidious, is the slow grind. No dramatic headline, no sudden crisis, just persistent, relentless physical accumulation, where metal quietly disappears from inventories, where lease rates stay elevated, where backwardation becomes structural rather than episodic, where every price dip gets absorbed immediately by buyers who are not trading, but accumulating. This is how paper markets die. Not with a bang, but with slow suffocation, where one day someone realizes the metal is simply gone. Now, let's talk about systemic contagion, because the real fear is not that silver reprices. The real fear is what that repricing reveals. If a major bank gets squeezed in silver, the damage does not stay contained. It spreads to counterparties, to clearinghouses, to risk models that assumed silver volatility would stay within historical ranges, to other commodity positions that suddenly look vulnerable, and most critically, to confidence. Because confidence is the foundation of every leveraged system. Confidence that contracts will be honored. Confidence that delivery will occur when demanded. Confidence that the paper price reflects some relationship to physical reality. And when confidence cracks in one market, it metastasizes. Participants start questioning other markets, other positions, other assumptions they had taken for granted. This is why silver is not just about silver. It is about whether commodity markets function as advertised, or whether they are managed theaters where price discovery is an illusion and physical delivery is conditional. And if the public concludes the latter, the implications extend far beyond precious metals. Now, here is the critical distinction most people miss: the difference between price and value. Price is what appears on screens. Value is what the world is willing to do to secure the asset. And right now, the gap between those two is widening. Nations are reclassifying silver as strategic. They are tightening export controls. They are securing refining capacity. They are building domestic supply chains. These are not the actions of governments that believe silver is abundant and cheap. These are the actions of governments that know value is rising, even if price is being suppressed. And when value rises while price is capped, pressure accumulates. That pressure has to release. The only question is how. There are two paths forward. The first path is managed adjustment. The system gradually allows price to rise. Shorts cover in an orderly fashion. Supply expands through new mining production and recycling. Demand moderates, and the market reprices over months or years without breaking anything critical. This is the scenario authorities are hoping for. This is what the emergency order was designed to facilitate. Time to adjust, time to reposition, time to avoid catastrophic failure. The second path is sudden repricing. A catalyst hits. Someone fails to deliver. A squeeze triggers margin calls that cascade. Price gaps violently upward. And by the time the system tries to respond, momentum has already escaped control. Retail investors flood in, momentum funds pile on, media coverage accelerates the move. And what was containable yesterday becomes uncontrollable today. Which path the market takes depends on two variables: how tight physical supply actually is, and how leveraged paper exposure actually is. If physical is abundant and paper is modest, managed adjustment is possible. But if physical is scarce and paper is extreme, then sudden repricing becomes inevitable. In every signal discussed, backwardation, lease rates, delivery stress, supply restrictions, strategic reclassification, all of them point toward the second scenario. Now, let's address the final question. What does failure look like? Failure does not mean silver goes to zero. Failure means the paper market loses credibility. It means participants no longer trust that contracts will be honored. It means physical metal trades at a sustained premium to paper claims. It means the price discovery mechanism breaks, and once that happens, it does not come back easily, because trust, once lost, is nearly impossible to rebuild. Markets can survive volatility. They can survive losses. They can even survive manipulation, if it eventually gets corrected. But markets cannot survive the revelation that the entire structure was a facade, that the metal was never there, that the promises were never backed, that the system was running on confidence alone, with no physical foundation. And that is what the emergency order was designed to prevent. Not permanently, but long enough. Long enough to reposition, long enough to secure supply, long enough to avoid the moment when the public demands delivery and discovers there is nothing to deliver. So when someone asks whether this story is true, the answer is, it does not matter whether the exact details are confirmed. What matters is whether the behavior fits. And the behavior absolutely fits. Nations protecting supply, paper market showing stress, physical demand draining inventory, concentrated shorts persisting despite risk, lease rates spiking, backwardation appearing. These are not random events. These are symptoms of a system approaching failure. And systems approaching failure do desperate things. The only question left is whether desperation buys enough time, or whether time has already run out.